What are some of the basic calculations I believe all home buyers and investors need to know before they even take the next step forward? Hi, I'm James Lim, founder of the Property Plus system, and today I'll be sharing with you 8 different basic calculations a beginner or to even an advanced level buyer need to know when they want to buy your property for either homestay or for investment. If you like this video, please feel free to subscribe for future videos. Let's move on. Now, the first calculation we need to know is the amount of down payment you need in order to buy a property. So in order to do this, we have to look at the loan to value ratio. Now you can see from here is that there are 3 different types of home loan that a person can take. So for example, let's assume that this buyer is looking to purchase his second property and his first property is not paid up yet, so therefore he'll be looking at his second home loan. And if his loan tenure is less than 30 years, which means he's going to take maybe up to age 65, you will see that the loan to value ratio is 45 years. And the total minimum cash payment is 25. Now, why does these two numbers doesn't add up together to 100%? Because you can use CPF. What it means is that the loan to value ratio is 45%, and therefore a person will his total down payment he need to use is 55% of the property price, whereby 25% will be the minimum cash while the outstanding can use CPF. Now let me give you an easier example. Now most home buyers, let's say for example age 45, they are going to take a lease up to a loan up to 65 years old. They will go by the first one where it will take the first home loan up to 30 years, less than 65, and the loan to value ratio is 75, which means you will borrow 75% from the bank, and which means the cash and CPF you will need is 25%, where minimum cash must be 5%, the remaining can be up to CPF. Now the second calculation we need is to calculate the total upfront cash outlay. Okay, and it will be on 4 components, because some of my clients ask me, James, is there any hidden costs? So I will put everything all up very transparent to them. Now these are all the costs, additional costs you need when you are buying a property. First is the buyer stamp duty. Second, if you are a PR foreigner or buying your second property, you have the ABSD. The third is your conveyance fee, which is your legal fee, and the fourth is your agent commissions. Okay, so let's look at buyer stamp duty. For buyer stamp duty, there is 2 formulas to calculate. For property that is less than 1 million, the buyer stamp duty calculation will be the property price multiplied by 3% minus 5,400. For property that is above 1 million, you can take the property price multiplied by 4% minus 15,400. As for ABSD rates, I would advise you to go to my website to see the full calculation for the ABSD rates. So now the ABSD rates is all provided over here. So after 2021 in December, there is a change of the rates. So for example, if you are Singaporean and you intend to buy a second property, the revised rates is now 17%. Or if you are PR and you are buying your second property, the revised rates is now in additional to the buyer stamp duty, it will be 25%. So refer to this table or to our article for the new ABSD rates. Now coming back, when we talk about the third and fourth one, the conveyance fee or the legal fee will be roughly between 2,000 to 5,000 depending on which law firm you use and the types of the how expensive the purchase price of a property will go. On average, I would say that most of the time I will deal with is roughly around 2,500. For agent's commission, do take note that when you are buying, you do not pay agent commission. Of course, when you are selling, expected agent commission will be roughly around 2. Now, for the third one, we need to calculate our monthly mortgage payment. Monthly mortgage payment means that how much cash I need to pay to the bank in order to finance this property. So what we will do is that we can actually click on this QR code to get to my mortgage calculator. So let me share with you what does this QR code comes to. So it will come to this mortgage calculator where you can add in your home value, you can add in how much down payment you're going to put in or the loan amount, change the interest rate and the loan tenure, and over here you will see that the estimated monthly repayment. where it will be broken down to the down payment, interest, and the principal. Alright, so for this calculator is very powerful as said in my previous video, because if you want to adjust this amount, it is possible, you know. So for example, if you feel that 2007 is too much, you can actually put in more upfront cash. You can actually change to 30%, and you can see that from 2002 it becomes 2,500. Or if you want to pay even more, you know, it will be even higher, where your estimated repayment will go even lower. Okay. However, if you want to decrease your loan tenure because you want to pay less interest, from 30 years you change to 15 years, you will see that the total amount will increase. So now this is the fourth calculation you need to know. So how do we look at the net rental income? The net rental income, we look at both the gross and the operating expenses. So to give you an exact value. So for example, when you buy a property and you intend to rent it out, these are some of the calculations in which I do for my client. So the rental income basically will comes from the potential rental income. That's how I get from them. Okay, and what I do is that because I always, for my clients, I always assume that maybe 1 month will be vacant because the tenant left and I need to find a new tenant, replacement tenant for my client. Therefore, I multiply by 11 months. So the total effective income will be 38,000. So these are all the expenses that my client may face. For example, property tax. You can look at maybe furnishing and upkeeping. And maybe you have to pay your condo maintenance. You may want to pay insurance. When you rent out a property, definitely you need to pay some agent commission. So all these expenses will add up to 14,000, and you can minus off to find your total rental income. Now, the fifth one I want to talk about is actually your gross rental income. Gross rental income is actually a very fast calculation, and it's not so much for you to know what is your cash flow. More important is actually to find out, or rather it is used to compare the different types of properties. So for example, the formula for the gross rental income will be the gross rent multiplied by 12 divide by your purchase price to give you a percentage. And this one you can use to compare which different properties will be good. So for example, you know, if you want to compare 5 to 10 properties, it may be hard to calculate your net rental income. But however, by using this gross rental income formula, you can pinpoint which property will give you the potential highest rental return. Now, the sixth example I'm going to share with you is the net rental yield. So just now from the net rental income, we can actually calculate how much will the total cash flow be. And from this formula, you can actually calculate what is the actual rental yield that you'll be getting. Okay, so for example, this rental yield is actually pretty good. Is that for you to decide whether you should buy property as a form of investment, or maybe you are comparing with other financial products. So the formula for this is actually the net rental income in the third example in which we calculate just now, divide by the purchase price times 100%. So the seventh example I'm going to share with you is actually the payback period. So what is payback period? Payback period is actually a time taken to recover your total cost of investment. So for example, let's say if I have to buy a property, how many years later will I be able to get all my money back, and this property will become free of charge for me? Okay, so the payback period is actually the purchase price divided by your gross rental income. Do look at our link to the article for the examples, the case study in which I've written for us to share with you, to give you as an example. Now, last of all is actually we look at your cash flow, okay? And this is called the cash on cash return. For people who are very tight on your cash flow and they want to calculate every single cent, so this is actually pretty good for you. So the cash on cash return will be your net cash flow versus the amount invested. So the formula goes like this, is that the annual cash flow, which means your property, your income, minus off your expenses, divide by your total cash that you invest in. And this will actually calculate for you what is your actual rental return. Okay? So now, I come to the end of this video. If you like this video, feel free to give a like button. Don't forget to subscribe, and do feel free to comment if you have any questions regarding any of the formula. Don't forget, we link this video to our articles, therefore, and our article will have all the examples given. As a bonus tip for my article, okay, I give you two other additional formula that is good for you. One is your safety net, how much you need to set aside such that you won't have any stress to finance this property. And number two is your capital appreciation, how to calculate your return of equity. So there you have it. I'm James here. Thank you, so long and bye.